a lot of these families, there's two different types. There's the kind that had an exit and they're sort of like the nouveau riche and they're sitting on a chunk of money. And they're the ones who are looking to really get into, statement class assets, like maybe owning football parts of a football team. So they could be known as the guy, oh, I know Ted, he owns, part of the New York Giants, right? So it's an elevation of status, it's legitimacy. On top of that, though, they also want the certainty that they're investing in, what we like is Class A industrial assets, because that sort of, there's a high barrier to entry to get into that.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, I'm your host, Ted Patel, and welcome to this week's edition of Decoding Cashflow Podcast. Our today's guest, Salvatore Buscemi, is a notable figure in world of finance and real estate. He has made a name for himself through his impressive portfolio of investments and his leadership role in various investment offices. Sal is a CEO and co-founding partner of Brahman Partners. Brahman Partners. Okay, thanks for that. And the CEO of Dandrew Partners Capital Management, and the author of several successful books on fund management and real estate private lending. Sal, welcome to Decoding Cashflow. I just give few lines, brief introduction. I want you to dive deep into your background, like what you do. I don't want to, give full bio and there's nothing for you to tell. So I just give a very
I
brief
understand.
thing.
And bios are boring, right? So, I think you and I were speaking, before this, we both worked at investment banks. I started my career at Goldman Sachs and did, a lot of real estate work, and, at the age of 29, I started and managed my own balance sheet. I raised $30 million from a $2 billion investment manager on Park Avenue. And this was during the great financial crisis, Ted, if you remember, like 2008. There was a lot of issues. So we bought basically everything we could from Bear Stearns at the point. We were buying it for pennies on the dollar. We were buying the loans at that point. And, fast forward on to that, we did another fund with another institutional raise. And then I was getting outbid on the markets. And I'm like, what's going on here? Doctors and dentists were outbidding me, going into like grocery anchored, necessity retails that were trading at a 10 cap, they were bidding like an 8.5 cap. And I said, let them have it. So we actually pivoted because of my partner, who was very formidable and well-respected in life sciences. We brought a lot of life sciences families into real estate. They have exits. They want to put it into real estate. And we invest only in Class A real estate. And we're doing that right now in certain growth areas like Salt Lake City and Las Vegas. We've had tremendous success. But since then, we've been doing a lot of venture investing through our family office, and we just gravitate towards the highest quality. And when we're talking about venture, I know this is a real estate podcast. We treat that the same as we would real estate. There's a human component to real estate, right, Ted? So it's not the real estate that pays the dividend; it's the operation of the real estate that pays the dividend. And it's the same thing too, is that we don't invest in first-time founders. We don't invest in first-time GPs, in real estate deals. So we use that as a way to insulate ourselves from risk, because all risk is human. And we like to work with the best-in-class people we can when the opportunities present themselves. We do not have a fund, although I do have a smaller fund that's a venture fund that's very well performing. However, the reason for that is because it's just kind of difficult with a fund structure. I actually have a LinkedIn post coming out on Monday talking about this, how a lot of fund managers today in real estate are really broke because of the fee structures that they use on a boilerplate document. Doesn't make any sense. So we are we're allocators into what we call private direct investment. Say we're investing into your deal, we'd just be investing the equity, right? I mean, what that looks like is a whole different story. Or maybe, if you are looking, although, it's not needed right now because there's so much private capital out there, private credit, we would come in perhaps as like the debt, right? Come in as a senior loan or a bridge or something like that. So we believe that, with our structure, with the families, 13 families that we invest on behalf of, we have a fairly unique structure that's very asymmetric because what it really does is that it incentivizes bigger investors to invest more and smaller investors not to feel or look as though that they're being subsidized by the whales. And we do that, with a very symmetric fee structure, which, balances the alignment of interest with our investors so that when we are approaching them, again, we're looking for speed. We want them to come quickly. We need them to, be responsive. So we need to make sure that they understand, look, the more you put in, the better it's going to be for you.
Yeah. So when you said you're working with, the family offices, right? Ultra high net worth individuals. So one of the asset that you invest through this family offices is real estate, as you mentioned. The others are life science as well as many other investment,
private
private
venture
investments.
Yeah.
So if you can give a little bit, in addition to real estate, what are the other sections or assets that normally big offices, family offices likes to invest in?
I think when you look at it, a real family office is defined by a family with at least $100 million in investable assets. And the reason for that is because it's like owning a yacht. 1% per year to manage, that investment, all that wealth, that's what it costs to do that. Legal, accounting, financial advice, what have you. Well, the boat is 10%, but if you don't take care of the yacht, what happens? The same thing. And we're starting to see families, who, coming apart at the seams because they didn't have that put in place. But what they're looking for are statement assets. A lot of these families, there's two different types. There's the kind that had an exit and they're sort of like the nouveau riche and they're sitting on a chunk of money. And they're the ones who are looking to really get into, statement class assets, like maybe owning parts of a football team. So they could be known as the guy, oh, I know Ted, he owns, part of the New York Giants, right? So it's an elevation of status, it's legitimacy. On top of that, though, they also want the certainty that they're investing in, what we like is Class A industrial assets, because that sort of, there's a high barrier to entry to get into that, but you also don't have tenants who are poorer than you. And so they're not looking to get rich, they're already rich. And when they have these operating companies that are throwing off a lot of cash, these established companies, that's when they're, if you look at Zara, for example, Armancio Ortega, every woman in the world has a Zara bag on her hand at any time, but he buys 1.3 billion in Class A real estate per year cash. We do the same thing. Not that much, but yeah. And statement, high quality assets, yes. And and to answer your question too about the venture stuff, we're not tuition. We don't invest in first time founders. All of our founders have had at least multiple exits. We like that. Number two, I like to see that other family offices are leading the investment too. That leads me to have a lot of confidence into, that they're smart and we're also aligned with smart people as well. It's easy, especially with AI today, although we haven't made an AI investment in 2 years, to sort of get into the groupthink and the hysteria and the, just the culture of just, everybody believing their own BS sometimes. So we're very careful about it, but the investments we've made have been really on track. And we actually had one exit earlier this year with a fintech company called Sing Life that was purchased by Sumitomo Life, its majority shareholder, for cash. So we like that. And again, it follows the convention that when these deals pop, all these families usually put them back into, high class, statement class real estate.
And in our conversation earlier, right, you mentioned like you don't do, these deals are not structured for funds, right? So how does the money flow from family office to your company to the investment? What's the structure?
That's a good question. So we use a master series LLC structure, which allows us to, work very fast when these opportunities come. Sometimes they need to be funded quickly. And that means that each deal is in its own standalone SPV. And, in this case, it's a series LLC. And it's great because it allows us to compartmentalize the gains and the losses. So if anything goes wrong, it's not going to contaminate everything else that's in the fund commingled with other assets. So what we do is we will put together an SPV. The families will subscribe to that using Green as BPM. And then they wire the money over to our bank. We use Zions Bank Corp. We use a Nevada Series LLC structure. And then from that point, we wire it over to the GP who we're working with. So, for them, it's great because they're getting access to opportunities they probably would never be able to get into on their own. For example, we're working with a family office for the first time in 50 years. They're taking outside capital, and they've chosen to work with us. So that's a unique value proposition, but also to that family office who's taking on outside LP capital for the first time. They're not going to have 10 different people on their cap table. They're just going to have me.
Mhm. So very interesting, right? You have been working with family office, these high net worth individuals for a while.
Mm-hmm.
How do you attract and build relationship with these high net worth individuals?
You have to be very patient, and when you meet people, you have to be in the interest of like learning about people and wanting to work with people. I think living in Miami right now, which is where I am on the 56th floor of my building, it's what I noticed when I first moved here was that there's a lot of people during the tech boom after the COVID that were very transactional. They were coming into your DMs, they're hitting you over the head, trying to sell you the hottest Bitcoin and everything, and it made it very, very transactional. And rich people don't invest in that stuff. It's for it is speculation for the middle class who are basically grasping at straws. Some
Mhm.
people did well, some people didn't. Some people went crazy because they thought they were going to be the next Warren Buffett, even though they never realized any of those gains, right?
Yeah.
And it was, sort of reminded me of the dot-com days earlier on. But what happened is that we lost I think it was COVID, but everybody became a hustler. And I don't mean that in a bad way, but like everybody was looking for sex on the first date when you're taking money from someone, you really should be courting them for marriage. And there's really no better way to say that.
Mhm.
And the way I treat the relationships, especially here in Miami, is that I have groups that I put together. I have one, it's called the 305 Intelligentsia. If you ever come to Miami, I'll introduce you. But they're families, and there's informal catch-ups and get-ups, and you just continue to build the relationship as if you were, families with these people. And I've known a lot of these people since, I was high at Goldman Sachs starting my career to today. And people like that, and they want to see the story. And if you're going to build and cultivate relationships and trust, that's the best way to do it. And that also means being on social media and being very consistent about your voice and vision and how you talk to people. I think too many people, and I mean this sincerely, and you can edit this out if you want, but I think too many people went to the Gary Vee school of sales and think that you're going to sell a $10 million investment in the same speed as you would a $10 book, and it doesn't work that way. And it
That's
turns
true.
off a lot of people, especially in a post-Bernie Madoff world.
Yeah. And it takes a lot of time to build a relationship, right? It's not like a superficial thing. You have to know the person in and out. They need to
Yes,
get involved with what you like, what you don't like. It's a personal
exactly.
connection that you have to build, of course.
Exactly. Yes, you got that right. And it
Yeah.
makes it, and when you put it that way, it makes sense. But I think too many people today, even with digital apps, like you have everything you want at your fingertips. Why aren't you funding me $1 million? Right? Like you have Uber Eats, you have Lyft, you have Tinder, you have anything you want in your fingertips. And I think that sort of ruined the whole construct of the familiarity of like being a human,
Yeah. That's
right?
true. Yep. Yep. So now, when you started uh, your companies, right? I know you have several ventures, but
Yeah.
when you started initially to raise capital,
Yeah.
what was your strategies? What was your initial strategy and what changed after that? What's your now?
So it's interesting. I was used to working with institutions, right? And a lot of your listeners don't have the background to really start soliciting, institutional investment advisors right now, or, investment managers for
Yeah.
money. But one of the things that I had to learn was that institutions are not family offices, and family offices are not institutions, although some of them are structured like that.
Mhm.
And the way an institution looks at the world is that they're going to look at the numbers and, they're going to do everything very, very well. The way a family looks at it, any sort of opportunity, is what's the story and what can I tell my spouse about it?
Okay.
Okay. So
All right.
nobody remembers numbers, but everybody remembers the storyline to all their favorite movies, right? You don't know your own body metrics, right, Ted? But hey, you certainly know, like, the Star Wars trilogy, how it began and ended, right?
Mhm.
Everybody knows that story, but those are the
Yep.
stories that sell, and those are the stories that resonated. And to be honest with you, when I was first going out to new families who didn't know me, it was quite difficult because I was speaking to them in a different language, it felt like. And people are not going to tell you that they're not as smart as you, right? And I'm not saying they weren't as smart as I am, but as it related to my proficiency and understanding of real estate, it was far beyond anything. And it really hurt me because I was talking to them, I was not communicating with them. And it wasn't until I wrote my first book that I understood that storytelling is really the secret for when you're raising capital for anything. Some of the worst ideas we work with, story, almost evangelical revelation that, this one guy, Adam Newman, is going to revolutionize the entire world, but really it was low interest rates and, stressed landlords, that bit into it. But a story can do anything. And if you're able to put it in a way where you're actually, and this is a filthy, dirty trick, but if you're able to elevate the status of your investor sooner on, then that's great. If they're able to go out to their friends and say, I'm in Ted's deal, it's the first deal this family office has ever taken in 50 years. It's special. It's a Class A industrial deal with other large investors. Now you got something, because people are going to pay attention more to that and how they feel about that and how they feel telling their friends about that than they will about the numbers, which today, unfortunately, in the political climate we're in, people have lost a lot of trust with numbers. Facts and figures lie. Numbers used to be an absolute, but today, they sell the manipulation, if that makes sense.
Yeah. No, absolutely. I don't understand the underwriting. When they're doing the underwriting, there are so many loopholes. You can use them, manipulate the numbers, but
if
of
you
course.
remove this, it's fine. And the government's been doing that, gaslighting us for a while now. Like you can't, like the CPI numbers, like if meat is too expensive, they're going to swap it out with chicken, right? It's a basket of stuff you're never going to know, but it's never going to change and it's never going to shoot up, right?
Yeah. And similar, like unemployment numbers, like they'll say, okay, unemployment went down, but after 2 months, they'll say, oh, we have a correction. Now,
now
we do
it's
this
a
much
correction.
So
it is, it's unbelievable. That's what's ruined, I think, humans' trust for numbers. And that's why when you have a story and it's something they understand, it goes to the different part of the brain and it activates different neuroreceptors and it makes it memorable.
Yeah. No, like for your initial investments, right? Before you had your first before you had a deal with a family office on your first investment, did the people whom you were dealing with say like, okay, there's no track record, or we need to how did you elevate that part of
That's a very good
the
question.
investor? Yeah.
So I actually was training a few people to do this who don't have a track record. I had a track record coming out of Goldman because that's just my understanding of it. And it's not so much a track record as your knowledge and understanding of the business and having the resources to get into it when you're young. Right. But there is, that is a component of it, is a track record of success. However, if I had to start all over again, and I've been asked this question before, I would raise money and learn to raise money around other people's deals in order to build a track record around that with judgment. That's the most important part, because, it's raising the money that is the most important part. If you're in real estate, the second rule of real estate, and it's the second rule they taught us at Goldman, but it was one of the rules that everybody learned the hard way recently during this great, interest rate increase that's caused the crisis, is that always be raising capital. And too many people thought the banks were just going to issue money out, drop it from a helicopter at low interest rates, sort of like COVID. But once that dried up, and I knew that interest rates had to go up at some point for many reasons, and also just the people who I pay attention to who are close in those circles, we made the conscious decision not to get into any real estate until after we saw at least a pullback on rates. And that's what we've seen so far, and we're going back into it. But I would raise money around other people's deals and make them the best deals possible, saying this is a Class A hotel, this is a up and coming area with a guy that has a lot of experience. And there's 3 rules I would use, and there's the 3 rules that I use before I allocate capital. Number one, no first-time GPs, right? You want someone that's been through at least 2 economic down cycles, and this one hasn't really started yet, Ted. All right. Number 2, audited financials. Number 3, I want the GP or the person I'm raising money for, I want to be able to tell my investors who's putting in a good sponsorship co-invest or a good equity contribution. And what that looks like, skin in the game. 5% is cute. 10% is thoughtful. Anything more shows conviction. And the more you get the people who are putting more money into it because they have more depth and they have more to lose, the easier it is for you to raise money around those deals. But you're not going to find many of them. You got to hunt for them and network. But if you're networking and you're building a good reputation and you're, pushing content on LinkedIn, or maybe you have a podcast, it becomes very easy for you to do that.
Yeah. Do you also run any like conferences? Do you do conferences?
We do.
Yeah.
We have for our investors, we actually just put on we have a lot of families who want their second gens who are mostly in their 20s and early 30s to learn the business. That generation seems to be a lot more, what's the word I'm looking for? Sartorial and serious. I think, they've seen things and they're a little more serious and driven than, the millennials. And I'm a New Yorker and, you can edit this out, but they're really, really steadfast on learning the intricacies of preserving the wealth because they know it is their steward to do that. And we had our capital raising mastery course, and we have another event coming up in February in Miami. These are great events that we put together. For those of you who are interested, you can email me, Sal at BrahmanPartners.com, BRAHMIN partners.com. And, it's in Miami, so you get to network too. So if you're here, you want to spend some time, you want to go to other parties and other events. And Miami is I can say it's the party central for people who are raising capital.
Yeah. All right. And now we talked about raising capital a little bit, but let's change our gears, move to the real estate side. Real estate, talk about real estate, right? What do you think about the current situation of the multifamily, or any other investment strategies that you like to suggest in the real estate, any real estate asset?
I think the point is, if you look at multifamily, it's a wealth creator, right? People get into it because you have to deal with the risk of having tenants who are poorer than you.
Yep.
But then, the government subsidizes that through loans, through GSAs, government-sponsored agencies, and all of that to make it easy to do that. It's a wealth creator, but it is, there's not a lot of glamour there. And even if you look at Jared Kushner, for example, your neighbor in Jersey, he did a lot of Class C to Class Bs, and then they bought 666 Fifth Avenue, and now they're doing all sorts of other real estate deals.
They're also going into build to rent nowadays. I heard.
Yeah, they are. Yeah, they are. So, I mean, it's an emerging of things that are going on. But, when you get into that, you just know that you're going to be rolling your sleeves up, and nobody is obligated to pay rent. And, you got to make sure you're on top of that. The tenants you have there are not, are not going to attract the wealthier investors. If you really want to go up market, go to other asset classes. I have a free training I give away. If you go to acpare.org, I give all my certifications in preparation of this and another podcast for people to learn, about the other 4 food groups. There's industrial, there's an office, and there's retail. They're not going out of fashion or style anywhere. I mean, they've been around for thousands of years. But you got to really, I think, start to expand it as to what is the most important thing, not for the guy I'm raising money for, but for me personally to build a career around.
And as of now, what do you think? Which asset class?
I love Class A
industrial.
I love Class A industrial. Yeah. We
Single
own
tenant
it. We love
industrial or multi-tenant?
Multi-tenant. Yeah. More, it has the congregations, forget the word they use for it, but yeah, it can be broken out. We like things that are like, 250,000 square feet that can be broken into 10,000 square foot sessions. It can be leased that way. It's really easy. It's very modular, and you don't have to worry about losing such a big tenant, right? You don't want to have someone, ghost you, your tenant leaves, go bankrupt, and then you have issues with it too. We also like office in certain parts of the country, like Salt Lake City. They have a different work ethic than New York, but it's also growing lots as well. And there's a lot of smart people out there, and there's a lot of industries and actually unicorns coming from that area too, as far as technology. That's really what we're looking at right now in the real estate space. We're not really going any deeper on that. We don't do any fund level investments. Funds are a 4-letter word. We like using the master series LLC structure because that shows, as I said before, an alignment of interest with the investors. They know what they're getting into. It's not like a blind pool, cover your eyes, hold your nose, and jump into the deep end of the pool. They know exactly what they're getting into. So, and they like that. They like that discretion. And I would advise anyone who's listening to this to, put together a structure or an offer to your investors that they have the discretion. They're not going into a fund.
Yeah, but these SPV vehicles, you can only uh, put that together when you have the high net worth individual, right?
No,
Like
you can
who
have
is
any
if
investor. I
yeah.
think, if it were me and I said, geez, we have this great opportunity in Ted's deal in northern New Jersey. I
Mhm.
don't know what it is. Let's just call it that. And he needs $1 million. No, what I'm gonna do is I'm gonna go out there and I'm gonna put everything together. And at the point where you have everybody sign the docs, that's when you start, at the point when you have everybody who's committed, then that's when you start putting the docs together to send out to your investors and open the bank account. So you don't do anything until you have a commitment. The people
Mhm.
really want to get into it and they're asking you for the documents.
Okay. So for this particular strategy, where I can find more materials to read on or to understand.
We actually did something. I posted something on LinkedIn actually on Wednesday this past week. I posted
Okay.
the difference between the series. If you follow me on LinkedIn, I put a lot of this content up there. But I posted something on the difference between a series LLC and a fund structure. And it's
Mhm.
on my LinkedIn page, Salvatore Buscemi. It's a great question you asked. And it'll be coming out in part of a newsletter that I'm putting out later this year too.
All right. So now, what do you see the future of investment would be? Like what are the like emerging opportunities that you see? Like you are seeing, your family office are seeing, outside real estate.
You're going to start to see a lot of movement into professional sports. I
Okay.
think you're going to start to see that. I think that you're also going to, you're going to see, I think, in a different way, depending on who gets elected. And again, to be apolitical, but I'm just, this is the spidey senses that I have working, being in an epicenter where
Mhm.
you have, a lot of Latin Americans, Brazilians, you have a lot of continental Europeans and New Yorkers that if Trump wins the election, you're going to see an IPO market that this country or world has never seen. Because
Mhm.
the US is going to be still solidified as a safe place for people to invest. And when you got to
Yeah.
think about this, and again, you're a citizen of this country, but from your home country, are people looking to save? Are they look? Are they looking to save their? I'll give you an example. Are
Yeah.
you saving for your kids' college education in Russian rubles or American dollars?
Of course, dollars.
Okay, yeah, there we go.
Yeah.
Okay,
Okay.
or
Yeah.
Chinese yuan, right? Like, that's the
Everyone
America.
wants the safety, right? Everyone wants the
Correct.
safety net.
But that
Yeah.
means that there's a tremendous opportunity because
Yeah.
there's been more wealth created, perhaps as a consequence of the pandemic, but also for other reasons that I wrote about in my third book, where everybody has a social media account today. And depending on your ethics, you can sell anything and make a lot of money off of it, right?
Yeah.
And so everybody, especially the younger generation, wealth has been democratized. And, it's really Amazon that pioneered this 30 years ago. And it's not even 30 years old. And it's already has $1 trillion stock market valuation. There's a reason for that. And there's a lot of wealth creation that's been set up around that. And that's going to flow into hard assets in the United States. If you are a North African dictator, I'm sure you own at least a couple luxury homes in Palm Beach in Southern California. You're not buying real estate in Libya, right? You're just not. It's not a store of
Yeah.
wealth, right? So,
Mhm.
and the Russians were a great example of this, buying statement assets all over the place. If you look at any very wealthy billionaire, they're all investing. If they're not, real estate families themselves, where they do a lot of value added stuff to create the wealth, like a Trump or a Kushner or something like that, they're all putting it into Class A statement class real estate. That's really what it is. You look at the guy who is the CEO of LVMH, the largest luxury, he just bought he just bought a huge office tower somewhere,
Mhm.
in Europe, I think in London, Canary Wharf, actually, to be honest with you. I mean, these are guys, this is, the people that own it and take care of that. You look at all the hedge fund guys, they all own these, baseball teams and Class A real estate. Even, the Mormon church bought Class A industrial in Florida. So, you're going to start to see that there's going to be a land grab, and America will really be probably a destination for tourists and wealth.
Mhm. Yeah. The one thing okay, many people don't understand is land is limited, right?
Yeah,
Yeah.
yeah.
You cannot produce land. You cannot have so where there is The
Correct.
things that cannot be produced, the price is always going to go up.
It is because it's inflation, but there's also going to be a need. But I'll tell you
Yeah.
what, we made an investment in SpaceX. We made three investments into SpaceX actually. And I can tell you what's going to move land prices the fastest is going to be Starlink and the availability for areas, as long as they have access to water, perhaps in the
Mhm.
middle of the United States, where you have these cities that are being built up because they have Starlink satellite. And, that will give people the opportunity to work in areas at the time that are cheaper, where it has everything that they need and they can prosper on their own because all you need is a Stripe account and a Starlink, right? And you're off to,
Yeah.
we invested in both, by the way, but
Mhm.
it's a matter of, disclosure. But that's really what it's going to be, is that you can be in the middle of like rural Wyoming, um, in your bomb shelter, making money, selling stuff.
Yeah, as long as you have a utilities and internet connection, you're
Yeah.
good to go. Yeah.
Internet connection first. Utilities, they ship it in somehow. But yeah, I mean, just like
Yeah.
the old West. But that's the way it's going to be, and the
Yeah.
infrastructure will follow.
Yeah. That's true. All right. Now, I know you have authored several books, right? So
Yes.
can you give a little bit overview on each of your book? Like what does it and just summarize, in a
Sure. Yeah.
nutshell.
So the after the great financial crisis, there were a lot of loans that were made in California. Hard money loans started coming into vogue.
Mhm.
And what happened was a lot of people were making loans that should not have been making loans, and they were overvaluing the land and ripping off investors. And so we put together a fund that was buying a lot of these loans for pennies on the dollar, as I said before. And then people said, well, what do you do? How do you do this the right way? So I wrote my first book, Making the Yield, which quickly shot up to $1,800 a paperback copy, but now you can get it for $19, from my website or Amazon. And after that, people want to know how to put together a fund. And so I wrote my second book, Raising Real Money, and I'm actually rewriting that for, a second edition that's coming out. And then my third book I did right during the pandemic because I was bored, but it was a way of answering a lot of the questions, and it wasn't very technical. It was more so unraveling the prejudices and the biases of the top 1,000 of the 1%, much of what we were talking about today in your podcast, what they invest into. It's not
Mhm.
crypto. I'm sure Jay-Z does not wake up and sees that some guy on Reddit's going to be investing his 401k all in and some Dogecoin, and he's going to do the same. He's too busy buying sports teams and media companies. And that's what the really, really wealthy gravitate towards are, those types of assets. They're not, a lot of them are not in the stock market, to be honest with you. The only stock they own are in their own businesses because they have businesses that throw off a lot of cash. And also they want something that they can control, and they can't control the stock market.
Mhm.
You're old enough to remember Martha Stewart being in jail for insider trading. Nobody, I mean, if you had 200 shares of her stock, you were screwed because you're not going to get Martha on the phone, but you're going to get Sal and Ted on the phone, right? So, that's the difference right there between having control and really understanding what's going on here.
That's something to think about, right? They don't they might have some portion of in the stock, but not very minimal. They play other games outside the stock market.
Well, the stock market is for people who
Who
can't
doesn't have
create
more
wealth on their own.
options?
Yeah, they don't have any options. Okay. They
Yes.
don't, they have no options. They have no options in life. They're just a 401k, a salaried employee with a red stapler. This is what you do. They're higher income. They know they can put as much of it into tax savings, and they hope another recession doesn't happen. Say,
Yeah.
you know,
Yeah. Yeah. And now let's talk about the mindset, right? This
mhm.
0.01%, the ultra high one. What have you seen the difference in mindset of these ultra high net worth versus the regular people?
Number one, um, the super high net worth people know when and what they're constantly being pitched deals, but the deals that they're being pitched are mediocre. So it's very difficult for them to really take, it's really difficult to penetrate those circles unless you have something that is of tremendous value to them. And that could be through enhancing their status or just putting a lot of money in their pocket. But even then, they're going to be kind of susceptible. If it's so good to be true, then why are you offering it to me? But really what it is that they value their networks much more than your average middle class person. Think about it. How many times do you know a person who's lost their job and like, Ted, I need a job. I lost my job. The wealthy don't have that problem because they have networks, and sometimes they pay for it in the way of like owning an NFL team, right? I mean, that's good for building, a network. It's like YPO and steroids, and I write about that in my third book. But they value their networks very much, and I profile in my third book, Investing Legacy, the 0.001% invest. One of my good friends and an investor, second generation family office in New York City, who traveled before the pandemic about 240 days a year. He's traveling more than heads of state. And, that's what he would do to maintain the network. And a lot of people are afraid to do that. They're bashful, they're shy, only because they've been raised in life to be a software programmer or an accountant, and if that's the case, then, you got to develop that skill set. It's like a muscle or anything else. And you got to come out and do it. If not, you got to find someone who can do that for you.
Yeah, no, you're absolutely right. Many people, they just hide behind the desk.
Nobody's gonna give you any money if you hide behind a desk. Remember, always be raising capital, and it's true.
All right. As I always say to my listeners, also, network is your net worth. All right.
So much so. I mean, if I'm not a tattoo guy, but if I were to get two tattoos, one would say always be raising capital, and the other one would say your network is your net worth. Absolutely, without question.
Yep. So Sal, loving this conversation, but I want to be mindful of your time also.
Thank you so much.
All right.
No, I appreciate you. Yes.
Before we move to the final round of questions, is there anything that you'll like to add?
No, I think follow me on LinkedIn, and you'll get to answer a lot of the technical questions that I post. I post every morning at 7 a.m. and I do that so that people like you can follow along and see the things that not only we're investing into, but sort of like the things that I'm seeing out in the field as it relates to series LLCs and funds and other things like that.
Okay.
Technical stuff.
All right. Yep, sure. So Sal, let's move to the final round of questions. Are you ready?
Sure. Mm-hmm.
All right. I know your books, but in addition to your books, which is the one book that you'll recommend which had the most impact on your life or on your business?
Ogilvy on advertising.
Okay.
It's actually a glorious business on book on entrepreneurship and building a company, but it's also incredibly great on business. And there's terms that I use there all the time that I've heard of. And anyone who reads that book will probably understand more about how to solicit investors and target investors than your peers. Because it's not about going up to someone and treating them like an ATM. It's about communicating in a way where everybody can understand. And he has a saying that says, the customer is not stupid, she's your spouse. And so if you can't communicate it in a way where you can't relate it to your spouse, then you're doing something wrong, because a confused mind never buys. Ogilvy on advertising, incredible book. It is worth its weight in gold.
All right. I'll just put that on my list of books to read. I haven't gone through that one, but sure.
It's an older book. I think it was published in like 89 or 91, but damn, is it good. And it'll change your life, really.
All right. What are your main source of information to learn and grow?
I love, right now there are newsletters that I subscribe to, private newsletters that you would never see really in the mainstream media, because the mainstream media seems to have an echo chamber. But these are people who, I pay money for to learn about what's going on in certain parts of the market, which is amazing. I also like reading like Zero Hedge. I like podcasts. I like listening to the Scott Adams podcast. He's a little slow. I like to listen to him on 2X, but he's very good as it relates to thinking about, the economy and things going forward, nuclear, politics. That's how he got his numbers. And then also another one is Alex Hormozy too. If you're starting out in business, he's really good, really principled and direct as it relates to the information that he provides. And that even helps an old dog like me, Ted.
All right. Okay.
Is that good? Did I pass the interview, Ted?
Flying colors. Flying colors.
Thank you, Ted. Thank you. I appreciate you. No, that's amazing.
All right. So what is the one best business or investment advice you'd like to give to our listeners?
Always be raising capital. If you're in real estate, always be raising capital. That's the second rule of real estate behind location, location, location. always be raising capital. And if you focus on that and you put your investors first and treat them like rock stars, your ego will follow.
That's great advice, and can't agree more on that.
Wonderful.
All right. So final question, Sal. How can
Yes.
Decoding Cashflow listeners get in touch with you?
They can send me an email to sal@brahmanpartners.com. That's SAL at Brahman, BRAHMIN partners, plural.com, brahmanpartners.com. If you want, we can onboard you to our multifamily platform, and you can see everything we do, and you can sort of peek underneath the TP, sort of to speak, to see what we're investing into, how we treat our investors. And it'd be a great way for you to lead by example. It's our leading by example. So hopefully your listeners will follow the same thing we do when we talk to our investors, that they talk to their investors in the same vein.
Okay. All right, Sal, it was a pleasure talking to you, and thanks
Same
for
here,
taking
Ted.
out the time.
Thank you so much. Yes, absolutely. Pleasure and a
All right.
privilege. Thank you.
Yep. Thanks a lot. Take care.
You
Bye.
got it. Take care.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.